Let's go. So guys, welcome everyone. Now that everyone's here, I think we should start. So today we're going to be talking about, oopsie, forgot to take this off. So today we're going to be talking about the Federal Reserve. There we go. Federal Reserve rate cut expectations jumped from yesterday to today after the USA CPI, 20%. So everyone was expecting, 60% of the market was expecting a cut, and now 80% of the market is expecting a cut for the month of November, for the month of December, because, you know, majority of the inflation came in as previous, as consensus. Only one of the data set came in to be a little bit higher than the previous, 0.2 higher than the previous. So again, talking about USA CPI coming in higher than previous, but that's a tricky, because it did come in higher, but only one data set came in higher. Okay, euro dollar targeting 104. That is correct. You know, lots of people have been asking me on the YouTube, and actually yesterday as well, on Tuesday as well, what I'm targeting on euro dollar. What's my target on euro dollar? Well, my target is 104. Okay, so I'm targeting 104. So we're gonna be having a look at this target, and why I think this is the reason why I think it could actually drop down to 104. All right. Okay. And then last but not least, combining global indicators and the Australian dollar outlook. I think someone asked me on Tuesday what are my thoughts about the Aussie dollar. I think we didn't have time that day to talk about it. So, oh, the risk disclaimer is still on the screen. Okay, let's go. Let me take this off. Perfecto. And now, let me put this away right here. And let's jump right to this CME tool. So I'm going to share this link into the chat, CME Fed Watch Tool. You guys have that link right now on the chat. Okay. So, well, there's so much things happening on the US dollar, and especially yesterday we had the release of the CPI, and you know, I was talking about this 106 level for quite a while already, and you know, I was trying to be very cautious as well on how I was approaching this US dollar index, but definitely with the monetary policy, and not only the monetary policy from USA, from the Fed, but you know, all of the other countries around the world have been falling short compared to US dollar. So there was a very clear view. When I saw that, I was like, yes, there's a very clear view here that the US dollar will continue to rally, and this is not a pullback. Okay, so some of the people were thinking about, yeah, look, this could be a pullback, but I've been mentioning about, you know, those levels of 61, yeah, retracement, that's good. But if we look here, we had a very, very consolidated area, another consolidated area, and then I broke through the top and a continuation higher to get the first consolidation, to get the second consolidation, and now we're breaking through to go all the way down, all the way up, maybe to here next year. Okay, I don't want to say that we're actually going to go all the way down, all the way up to 115,000, but it's just because we're still on a very big consolidation, and we are on the top of the range at the moment, right? Maybe we can just touch on the top and then come back down all the way down to this area. Okay, maybe that can happen. Okay, Would that be possible? Definitely, especially next year, right? Maybe over the next 3 to 6 months, you know, I want to talk about some factors. They will potentially give some upside for the dollar. However, while we, you know, anticipating some strengthening to the US dollar, I do believe that we can break through this high. Okay, I do believe that. We do have a high on here, and we do have a high on here as well. Okay, so we have those two highs that we can most probably get rich very soon. Okay, let me just clear all of those rows. That is perfect. So coming back to CME, we've had the release of the USA CPI. So you can just come into FinLogics and then go into Tools Economic Calendar. I'm going to send the link onto the chat. Economic Calendar. Oh, sorry. Calendar. Perfect. So you have the link right now on the chat, so you can follow up with me as well. But if you click on today, you will see the USA inflation rate month over month, the core inflation rate month over month, the core inflation rate year over year, and the inflation rate year over year. So some things I want to just mention it here. I know that maybe it's not the best to use, but what I will do is I will get a spotlight. That's better, all right? So if we look at the United States inflation rate month over month, it came in as expected, okay, 0.2, 0.2, and came in as the previous as well at 0.2%. So that's good, nothing changed. Now, the United States core inflation rate month over month, it came in to be as expected as well, and no changes from the previous. Same for the core inflation rate year over year, because that's good. That's something that is really great, okay? That's something that is really great because, as we all know, one of the biggest measures that the central bank from USA takes in account is the core inflation, especially the year over year and, of course, the month over month. So those two came in to be as expected and no changes from the previous. Now, if we look to the inflation, the normal inflation, not being the core inflation, the year over year one, we can see that it came in to be 0.2% higher than expected. Okay, so if we look at the previous 2.4, and now if we look to the forecasted 2.6, and it came up to be actual 2.6. So that means that from the last year, October, so how this is taken measure is, I know that some people maybe don't like me to draw, but I will have to draw now so I can explain it on a better way. Maybe this one in black. Oopsie, that's not what I want. Perfect. Oh no, what's that? Oh, it actually disappears. That's interesting. Oh, that's the one. Okay. So from this means year over year, and then you have a month here. See, month of October. So what means is year over year. Okay. So if it says October, all right, OCT, October, then it's from the October 23, right, to October 24. That's a 12 months, and that's a full year. So that means year over year. Okay, so from the October 2023 to October 2024, we've had a rise of 0.2% inflation. Okay, so that's pretty much how they take this measure on. Does it make sense for everyone? I think it's pretty good, right? Okay, so that being said, we've had the short-term bonds, okay, the very short-term bonds, the 1 year bond. Let me take this off. So US 01Y that we can take, sorry, not USD, US. There you go. We've had, I like to USD into a line. That's a 4 hour. Let's go for the 15-minute. What time was the release? Midnight 30. So midnight 30 was here. Okay, perfect. All right, so we can see that as soon as the inflation came in, that is right at this time, midnight 30, you guys can see right in there, we had a huge drop on the market. And since then, since then, nothing happened, right? So if the US 1-year bond drops, and as well as the inflation drops, then means that euro dollar will drop. Sorry, euro dollar would go up, right? Well, that's not the case. And why is not the case? Because the Trump trade is all the opposite, okay? So if I zoom out and just try to place them together like that, we can see that while the US 1-year bonds was going up from here to here before release, euro dollar was going down. But then when the inflation drops in, this massive move, pretty much 100% correction, we didn't saw anything happening. And we only saw this little move here and then a huge drop again. So that's the power of the Trump trade, okay? And that's why with the inflation coming lower, we could see the targeting rate probabilities for the 18th of December 2024. I'll send the link in the chat. You guys can click in there. We will have access to these. You will see that the probability now for a 25 basis point cut is 83%. But yesterday was 58% before the CPI. So that is a 25% increase into the probability. Remembering, this is not the central bank tool. This is the Chicago Mercantile Exchange tool, the Fed Watch tool. That is a broad pool of people that vote into, I think it's going to hike, I think it's going to cut, but it's not anyone. It's like really good people, really good economists, traders, big banks, etc., forecasters, and maybe even some government people that work for the government. And now they're predicting 83% of a 25 basis points cut for the 18th of December. Right. Okay, that's good. That looks pretty. That's pretty good. So what does it mean to the US dollar? Can we apply this to the market? Right. Before we go any further, I want to talk some boring stuff, right? I know people don't like me to talk boring stuff, but we need to, okay? So, as we've seen, we're analyzing some recent movements on the US dollar, and most of those movements has happened because of the US election, all right? So yesterday we saw the appreciation of the US dollar right here. Let me move down to candles now. So we saw this huge appreciation. This is bullish. It's bullish candles, and showing that the Trump trade is still alive. Okay. However, despite this this reaction, I do believe that there is a high probability for even further US dollar appreciation. Okay, even further US dollar up move. So the new President Trump, he was, I was thinking of, Trump will win this election, but I didn't thought that he would win so hard, so good. Like, it wasn't that a closed race, while they were, sorry, it's so boring that made me boring. Sorry. So while that we're actually drawing the votes, the state, I was thinking, oh, okay, that's pretty close. You know, we've seen Kamala Harris with, I think, like 112, and then Donald Trump with 120, and then out of nowhere, Donald Trump jumps from 180 to 215, and then that was over for Kamala Harris, right? So it was a really strong mandate. So this could drive, and you know, it will drive him to act on campaign promises. So such as the trade tariffs, deportations, because he's really big on that, tax cuts, of course, especially now with Elon Musk, you know, on the dodgy. Forgot what that means for, but anyways, increase fiscal spending on the 1st of January. I've talked about that on yesterday webinar. And anyway, so if those policies are quickly implemented into the White House, we're likely to see some boosted yields. All right, so maybe long, short yield. So US 10-year coming back to where it were before election, and US 2-year, you know, not quite there, but we're getting there. Sorry, that's the 15. Need the 1 hour. Perfect. Yeah, so actually it was better previous election. Yeah, so previous election we were trading at 4 highs of 430, and now we're trading on 430 as well. So pretty much the same 1 week after. That's really interesting. Yeah, as I say, you know, things are quickly happening. So we most likely will see these yields coming higher. And of course, this will support the US dollar strength. Okay, so that's why I believe that we can go even further than 106. Maybe 107, yes, maybe 110. I don't think 115. I think that's too much for this year, but maybe 108, 107.5, maybe. So as I was saying, over the next 3 to 6 months, those factors will, it's suggesting at least, you know, a potential upside for the US dollar. So, however, while I'm anticipating those short-term gains, there are some medium-term factors that could challenge this trend. The first one is the inflation expectations have been shifted, you know, unlikely in 2016, inflationary pressures were much higher. And you know, there's less spare capacity on the US economy. For example, while the inflation average was 0.9%, if it doesn't fail my mind, in 2016, now we're seeing those figures at 3.1%. So this could shift, you know, start to wait on the dollar if the inflation remains elevated and the policy responses are constrained from the FOMC. Another factor to watch is the potential for trade tariffs. You know, we've talked about that quite big on Tuesday. I've even mentioned it on the webinar. So for those, just a little pause here. For those who don't know, I think majority that are here know already. But for those who don't know, we have a channel on YouTube called ACY Securities, and we post every webinar replay in there. Okay, like for example, this one, as you guys can see, we've talked about, there we go. We've talked about the second topic was impact on fiscal stimulus on the US dollar, on euro dollar. Okay, so if you haven't yet watched, I'm gonna webinar replay. Put down the link on the chat so you guys can follow up. So coming back, you know, as I was saying, it's the trade tariffs is another good factor that could we have to watch for. So while the Trump mandate is, you know, it gives him a strong position, you know, implementing wide-scale tariffs will likely face legal challenges, as we all know. So if Trump pursues this aggressively, especially with unclear justification under the trade law, it could lead to market volatility and further impacting the US dollar. So this is something that we need to always watch out for. And finally, potential conflicts, most likely between White House and the Fed. We know this will happen. We know the Jerome Powell and Donald J. Trump don't go well together, right? We know that. We've seen this, and they are, sort of sparkling with each other. Let's say sparkling. When two rocks collide and then they do a little spark. Yeah, that's pretty much Donald Trump and Jerome Powell. They don't like each other. They have different views into the monetary policy. It's going to be really, really interesting to see how this will go. Trump has previously hinted that he would be firing the Fed officials, and one of the journalists has asked him, Jerome Powell, in the last FMC meeting committee, if Donald Trump could fire him, and he was like, under the law, he can't. So under the law, looks like Donald Trump can't fire Jerome Powell. And Jerome Powell feels like, I think the same journalist asked him, will you continue to do the exactly same things that you've been doing, And he was like, yeah, there's no reasons why I should change what I'm doing. So we won't be seeing any we won't be seeing any changes on the monetary policy from John Paul's side. Okay, so this could introduce further instability if that actually happens. If Donald Trump comes and fires Jerome Powell, most likely we will see some instability in the market. Okay, so if the administration interferes with the Fed's independence, then the dollar could most likely face downward risks. Okay, so pretty much in summary, just finishing up the boring things here, but this is very important. I had to talk about it. Why I'm expecting the stronger dollar to sustain it in the coming months. I don't know how sustainable this trend could remain, and if uncertainties comes up to the market. So factors like the elevated inflation, legal hurdles on the tariffs, potential of the Fed interference from Jerome Powell interfering the Fed. This could all change the dollar resilience over the longer term. Okay, so we're talking about longer term. We're talking about 1 year. All right, we're not talking about tomorrow. So just everyone knows. Does anyone have any questions? So far, so good. How's everyone traveling? No questions? All good? Oh, that's too good. Come on, 0 questions. Okay, that's fine then. All right. Now, let me just answer these really quick. Perfect. Okay, so we've talked about the Federal Reserve rate cut expectations jumping 20% from yesterday to today. We've talked about as well on the USA CPI. And now, USA CPI. And now euro dollar, I'm targeting 104 on euro dollar. Okay. Green say is expecting, Green say is waiting on the gold discussion. Okay. Let's talk about gold a little bit later. I think I had gold on the pipeline today, but I can talk about gold because let's just go over gold first because I don't have gold on pipeline, but gold has been pretty good since we've mentioned it. I don't know if you guys remember that, but I've been mentioning that since when President Trump got elected. He didn't got into power yet. He will get into power next year on the 1st, but on the 13th of January, if I'm not wrong. When does Donald G. Trump gets in power. I think it's on the 13th. I don't want to lose too much time searching for that. January 20. Okay, so it's going to be on January 20, 2025. It's right there. It's around the corner. 2 months for the big man getting to power. Okay. So green has been waiting for that. So let's talk about gold. Not a problem. So first of all, I just want to say that my target on gold is $2,500. Okay. And I've mentioned that 2 weeks ago. And it's here just to prove that the strategy that we use actually works really, really well, okay? And the market always try to bounce back to those boxes. Can you see that? Bounce it back to this box first, of course, and then now bouncing back to this box and so on. So soon it drops below the 2,600, right on this support here. 2,600. I was like, yep, this is going to go down to 2,500. That's another $100 move down. I was having targets before Donald Trump getting elected on 3,000. Okay. But, you know, seems like we didn't get quite there. We were pretty much $100. Was that? No, a little bit more. Sorry, $200. $200 away off the target. But for those who have been trading gold since the beginning of this year, 2024, you could generate some massive opportunities and massive amount of profits as well. You know, so if you look at to 2024, right here, it's right at the start of 2024, we had right there gold at $2,061. So right now we have gold at $2,557. So that's a pretty much $510 up move. That's really good, you know. With leverage, you could be making some really good money with small percentage of capital. You know, maybe with just a minimum deposit of $50, you could turn that in $100, or maybe with a deposit with $100, you could turn that potentially to $1,000 with leverage. So you know, everything has its risks. As the same side, it could go up. You know, it could go the completely opposite side. It could go completely opposite side as like that, and then things wouldn't be looking good. But we're just looking at the past right here. Okay, so that was pretty interesting. What do I think about gold from now on? Sorry, guys, let me just drink some water because my throat is getting wrecked. All right, perfect. So my thinking about gold is, if we break through this little sort of support here in 2,546, we will continue to decline to 2,500. Okay. Once we get to 2,500, until we get to 2.5K, I think that should be it for the year. Okay. And we most likely will have a reversal. Now, why do I say this? Because if we look historically to gold, let me just bring the prime market terminal here very quick. Okay, so let it load first. Oh, wow, that's really slow. Damn. Okay, so if we look at gold into the seasonality of gold, sorry, we can see that the month of November is typically a really bad month. So the month of for the month of 2020, November was 5% down. The month of the year 2020 was 5% down. 2021 was 0.38% down. So 2024, the prediction is to be -7% down. Okay, 7.5% down. So let's just look at the daily chart and let's see when was the start of November. Take all of this off. We're doing just a data analysis here. Okay, so there we go. From that, from right here on the opening, 7% down. So somewhere around here. Yeah. So that would be somewhere around here. And from there, we could be looking at December, a 3.39% up move. Since 2020, we haven't had one December with negative. All right, so some people say buy at the dip in September and short at the high in December. All right, December and July are the best months to long gold. So my strategy coming to the month of December, what I will do is I will wait until December starts. So right here. So we have this pretty much 15 days left. So if we look, where's my pen? If we think about it, I think TradingView had a nice, where is that thing now? They had a nice tool that you could use. There we go, bars pattern. So if we look from here to here, is it? Okay, let me try it again. So if we see something like that, well, that's not what actually I want. Oh, there we go. I found it. Perfect. So if we look from here to maybe here. So, oops, sorry. We're looking at something like that. And then a 3% up move, maybe. Let me check how much is that. 3%. Yeah, somewhere around here. You know, so most likely we will probably longing gold somewhere around here. And now we'll be looking to get these high to here. And then as we all know, January has another possibility of 0.79%. So that's pretty good. Okay, we can't complain. Another 0.3% won't be much, somewhere around here maybe. But, you know, it's always good to trade. So yeah, that's pretty much what I'm looking at gold at the moment. You know, we've been here at the seasonality tool. Now, if we look at the DXM, you know, so another point is yesterday we've had a new strategy that I'm gonna be trading with everyone every Wednesday. So if you haven't yet, you haven't had time to come into a Wednesday webinar, make sure to be in there because that's when we're going to be trading together. Okay, we're going to be managing a portfolio of $100,000 together. So yeah, majority of the traders are long, so that's why, of course, market is going down as well. So I would be waiting for this to turn around to enter long on gold. Okay, so as they say, that's pretty much my my analysis for gold green. Hoped I helped. What else I have to show? Pattern. There's no pattern prediction. Yeah, that's pretty much it for gold. All right. PPI today, I expecting to make dollar stronger. Thanks, Luca. Thank you for the seasonality analysis. Not a problem. Actually, you know, it's a very simple tool to build. All right, seasonality is very, very simple. I know I'm literally getting out of concept now, but I just want to show you guys. It's simple as it is. So basically, we take 2020, 2021, 2022, 2023 closes. So January 2020, 4.56% up, 2021, negative 2.8, 2022, negative 1.69, negative 2023, positive 5.22. Sum this all together, and then we have an average of positive 0.79. Okay. So really interesting. Okay. Now let's move on. So many questions in the chat. So PPI today are expected to make it US dollar stronger. Yes, that is correct. Now let's just finish euro dollar, because there are people already pushing us to go to Australian dollar outlook. Are we gonna get there? Relax. So if we look at the daily chart, let's come back to here. Oh, we nearly got triggered. Okay, that's all right. So if we look at the euro dollar chart, we are on a consolidation, right? You're right in a consolidation right here. These are the extremes. 104 is right down in the corner. Okay. So I do believe we're going to break down. And remember last year, I've mentioned about euro dollar being on a range between 1.10, 1.12 to 1.5 here. Now, I think into 2025, we're going to be looking at 1.05 to 1 to 1. So that's going to be our consolidation sort of range. Okay. The market will most likely be bouncing back here. So I think we're going to just tap into it beginning of this year to, beginning of 2025, finishing this 2024. Green say, I will wait for NFT dip on gold in December, then enter bullish for the rest of December. Yeah, that's what I'm going to be looking to do as well. Someone else says, okay, so let's move on. Let's move on. So US dollar, sorry, Australian dollar outlook. Let's have a look at the Aussie dollar. Okay, so we have actually lots of things to talk about it. Okay. So first one is where is, oh, there you go. Perfect. Okay. So I think, so we have some economic indicators like the domestic economic indicators here in Australia that we've seen today coming in to be, weaker than expected for the unemployment rate. But despite those external pressures, the domestic interest rate policy have been providing some support for the Australian dollar. But the RBA has, maintained a very conservative stance, and they are indicating to us that no imminent rate cuts until next year. Okay, so RBA won't be doing rate cuts until next year. That's what they say. It's not what I'm saying. Okay, so the market currently pricing a modest expectations for further reductions, around 40 basis points over the next year. And this conservative instance signals some stability. I thought some economic challenges will continue. So if we come here into the interest rates probability, a second. There you go. Yeah, the Reserve Bank of Australia, we're looking for the next meeting on the 10th of 12. Just a second, someone wrote something on my screen. Oh, no. Perfect. So on the 10th of December 2024, they are expected to hold, and the probability is 88%, and the current rate is 35%. Okay, so the wage growth data, it's recently showed to us a slowdown, primarily due to the smaller minimum wage hike in 2025. But while the quarterly wage growth is somewhat stable, the year-on-year growth has dipped from 4.1% to 3.5%. That's a pretty big dip, okay? It's very stiff. this trend not only reduces the consumer purchasing power, but it also softens one of the supports for the Australian dollar, creating a mixed outlook for future RBA policy adjustments. Okay, so another thing is that the retail sales data highlighted a preference among the Australians to save the money rather than spend their disposable income. So likely in response to economic uncertainty. And, despite some recent rate cuts and utility rebates that we had here in Australia, consumers, remains uncertain. They continue to remain uncertainty. And this suggests to us that even if the wages goes up, the spending hasn't followed this. And this conservative spending behavior from the people, the society, will definitely influence the RBA rate policy decision. So, which will lean towards some future rate cuts and not now, right? So, interesting and very intriguing as well. The employment rate remains resilient, with the job ads staying high and the unemployment rate close to the natural rate of around 4%. So if employment continues to grow, this could complicate the RBA tasks on balancing the rate policy. And a stronger labor market generally supports the wage growth and spending. But given the broader economic slowdown, most likely the RBA may have to consider rate cuts carefully. Right, it's very different from all the central banks around the world. So basically, in conclusion, the Australian dollar is somewhat complex, and it's facing some complex set of situations. With U.S. political uncertainties, domestic wage growth trend, consumer behavior all playing a role, and all while the RBA has taken a cautious approach to rate cuts. Ongoing developments in both the global and as well the domestic economy will shape its next moves. Okay, so for traders and for investors, understanding those types of factors will be definitely crucial for assessing the Australian dollar future prices. Now, do I think these can potentially pull back? No, I continue to believe we may come down to the bottom of the consolidation somewhere around here. Okay, 64. 64 would be the target, 64. All right, so we've come to an end. We've covered out the Federal Reserve rate cut expectations jumping 20%. We've covered down USA CPI comes in higher than previous, but it was a cheeky high, isn't it? It was just 0.2, but when the whole set of data came in to be as expected. Euro dollar targeting 104. And for next year, I'm changing my perception from the consolidation area of euro dollar from this year. So this year, I was looking like to 105 to 1.10, 112. Next year, I'm looking to 105, 1.0, so parity, okay? And the combination and the combining global indicators and the Australian dollar outlook is continuing to be bearish. Guys, thank you so much for being with me today. I really appreciate the questions. I really really appreciate this all the time. You guys been here listening to me. Sometimes are boring stuff, but hey, you need to understand those types of fundamentals. You need to understand those types of economic situations around the world. Thank you so much. I see you in the next week, or otherwise, I see you tomorrow in the video. See you guys. Take care. Bye.